Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Here with Value Stock Geek, joining us under a pseudonym, which is fine. You don't need to be a real person. Well, you need to be a real person, but you don't need to have your face and name necessarily attached to your views to join the Contrarian Investor Podcast. So Value Stock Geek here has been on the show before, and we discuss your weird portfolio, but I want to talk about some holdings that you've added in the last couple of years, or in the last year, actually. And there's three of these. They're all tech. Google, Meta, nay Facebook, and Taiwan Semiconductors. So admittedly, maybe not the most contrarian thing here, but I guess what is pretty contrarian is the fact that you are still long these stocks as the US potentially enters an economic downturn, which would be bad for growth stocks. So tell me your views on maybe starting with Google.
Sure. So I bought all of these stocks last year into the tech decline. So I've been waiting for a long time for these great businesses to be available at some compelling prices. So last year, all of these businesses hit pretty attractive valuations. Google got down to about 15 times earnings. Meta got down to about 10 times earnings. Taiwan Semiconductor also got down to 10 times earnings at the end of last year. So I've really just been looking at, that's generally my approach is I look for businesses. I track them for a long period of time. On my Substack, I build up a big watch list of companies that I think are great. And these are three companies that I've always thought were pretty great. And I've just been waiting for the opportunity to grab them at an attractive valuation. So starting it off with Google, last year, Google got down to a pretty attractive valuation. I bought it around 15 times earnings. The concerns about Google right now are about the potentially an upcoming recession. And then there's also concerns about AI. That's another big concern over Google, that they're basically the search business will get disrupted. So that's a big concern there. I think when you look at the actual business results, that things are still pretty good, that hasn't been a major disruption in their actual business results. And a lot of what's going on right now is speculation about what might happen in the future. And to me, that's the perfect kind of setup. You have a business that's not actually in serious trouble right now, and it's mainly being beaten up over speculation about macro worries. And in my view, those macro worries, like an upcoming recession, are pretty unpredictable. So we might have a recession this year. I don't really know. I don't really have a view on it. The reason I generally buy stocks is to hold it over a 5-year period. And I would expect over any 5-year period, a recession is a potential threat. So that's why I generally stick to businesses that have moats and businesses that have shown in the past some level of recession resistance. One of the first things I always look to when I buy a business is its performance from 2007 through 2009. And the thinking is that a 2007 through 2009 environment could happen at any time.
Okay, that's some really interesting stuff. Now, going back to Google, you said that AI is a potential overhang, at least for the search business, but it's interesting because AI and what they've done with AI has been a big catalyst for the stock to move higher this year. It's up 30% this year. So how do you think that this is necessarily a zero-sum game with AI and the search business, or yeah?
So the concern about Google is that obviously Google search is the key aspect of its moat, and Google search has been fueled by algorithms over many years. And people have that ingrained habit that when they want to look up something, they will Google it. Google
It's
has
literally
become
a verb. Yeah.
Yeah, it's become a verb. I'm going to Google something. So I think even if better search engines powered by better AI come along, I don't think that ingrained behavior that people have will get disrupted. I don't think that in 5 years there will be some better search engine, like let's say Bing provides better results powered by AI. I don't think people will change that habit where Google still will control in excess of 95% of all search on the internet. So I'm not too concerned about that. With that said, Google's AI, I think, is just as good as ChatGPT. Like I've tried both out, and they both seem Bard versus ChatGPT, and I think that they're pretty similar. I usually get pretty similar results. Like they both can deliver results that are factually incorrect sometimes. I think there was a lot of press made when Google first unveiled Bard, and it gave some wrong results. Well, I've gotten incorrect results from the other chatbots. So I think that was a little overblown. And recently, Google has announced a lot of progress that they've made in the AI space, and now it doesn't seem like that's as much of an existential threat as people were worried about a few months ago. And I think that's generally how things go with every stock. People overreact to things on the downside and the upside. And I'm trying to capture really good businesses when they're a little beaten up and expectations are a little down, which I thought was the case last year.
Yeah. What is the business case for AI and specifically for Google? Like, I mean, I know they have this Bard thing and they're launching an app supposedly soon, but what is it, just to integrate with its search in a different way and show ads that way? Or what is it?
I think of it more as a threat to Google. So
Yeah.
I think of AI as like there could be better alternatives that can come along, and it's more. I don't know if there is really much of a business case for AI. Like I don't really have any view on that. What I'm more concerned about is, will people continue to use the Google search engine? Will that get disrupted? Is Google taking efforts to counter that disruption? And I think that moat is pretty much intact, and I don't think it's going to get disrupted over the period of time that I plan on holding the stock, which would be like 5 years.
Fair enough. All right. Interesting.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
And so then Meta, now that's been an interesting stock here. Their big bet on the metaverse. They literally renamed the company to Meta, but that hasn't really gone all that well. But yet the stock has rebounded. It's doubled this year, just about. So I imagine you're sitting on some pretty big gains. Are you trimming your holdings at all or not?
I'm up just a little bit. I got a little too eager to buy it when it was beaten up the first time. So I bought it, a little over a year ago. So I'm not up huge on the position. I've owned it through the decline, and then I've held it through the upswing. So I'm basically just holding on. My thinking on Meta was last year when it first started declining, it started declining on concerns about the metaverse. So the concerns are obviously that Mark Zuckerberg has been spending way too much of the company's cash on the metaverse, and it's not really going to result in any gains for the stock. And there were also concerns that Meta was also going to lose some ground. So there were concerns about TikTok digging into the amount of time that people spend on the Meta applications like Instagram and Facebook. And there were concerns about that. My view is they got way overblown. The stock was beaten up way too much over all of this. If you looked, for instance, at the daily active users across the Meta platforms, there was almost no disruption in use of the actual platform. So that was what I looked at when I saw the stock declining. I said, well, this all seems like speculation. Like people are just freaking out about nothing. Even if you just assume that all the cash that was spent on the metaverse, if you assume that resulted in absolutely nothing, it was still a good business. Like they could spend that cash and it's not the end of the world. So as far as the metaverse goes, I think it could possibly work. I don't necessarily think that Zuckerberg has lost his mind. I think that the metaverse could turn into something special. What that is, I don't really have any idea what that could eventually turn into. But like I said, even without that, I still think it's a pretty good business, and expectations got way too beat up last year. And this is still one of the best advertising platforms in the world.
Yeah, interesting. So it is very much in your case a bet on the legacy business, and which I guess now includes Instagram.
Yeah, and I think you have the legacy business, which is still doing fine. Everybody that you talk to will frequently say in my circles that they're not using Facebook anymore, but you look at the actual data and that doesn't seem to be happening. So I don't know if people are lying, or maybe Facebook is turning into McDonald's, where everybody claims that they never eat at McDonald's, yet I always see the drive-thrus packed. People definitely use Instagram. Instagram's definitely a growing platform, and it's not just in the United States. I mean, Facebook is growing internationally. They also own WhatsApp, which is an excellent application that is used widely throughout the world. So I haven't been too concerned about any of that. I think that legacy business is intact. I think it's performing well. And then with this metaverse, there's some optionality there that could turn into something in the future, that could turn into something big. And if it doesn't work out, it's not like they can't turn the spending off. Like, they can absolutely stop spending so much cash on the metaverse. And recently, Zuckerberg has shown to shareholders that he's willing to possibly cut back on the spending if it doesn't result in anything. And he's also shown some capital discipline. He's been willing to lay off some employees and reduce some of the excess in the workforce. So he certainly hasn't lost his mind, which seemed to be the consensus a year ago, that Zuckerberg has just lost his mind and he's blowing all of this money on the metaverse. And he controls the company, so there's nothing shareholders can do about it. So people really freaked out about that. But I think he's demonstrated to the street recently that he hasn't lost his mind, and he's still a pretty adept business person.
Any prospects of them returning some cash to shareholders via buybacks or anything like that?
Yeah, I think they did buy back stock last year. Okay. They bought back a little bit, but yeah, I mean, in the future they could absolutely turn into more of a shareholder yield machine. They've focused over the last decade more on growing those core platforms, but I would also be content if this turned into kind of a shareholder yield story where they're buying back large amounts of stocks, or they pay some nice dividends in the future.
And then TSM, Taiwan Semiconductor, that is an interesting one that you say you're not, you don't look at economic cycles so much, or you look at them, but you don't really react to them. But this is a cyclical industry, the semiconductors, isn't it? And didn't they do very poorly from 2007 to 2009?
Yeah, it's definitely a cyclical industry. It will definitely be impacted by a recession. However, I think that the long-term prospects for growing semiconductor demand are still intact. And like I mentioned earlier, I'm always holding a stock and thinking a recession can just pop up at any time. The question is, will the company survive? And if I hold it for like a 5 to 10 year period, will demand for that product increase? So I think without question, as the leading semiconductor manufacturer in the world, that Taiwan Semiconductor will be a bigger company in 5 to 10 years than it is today. The question is, are we going to have a recession this year? Are we going to have a recession in a couple of years? The other kind of macro worry weighing over Taiwan Semiconductor would be worries about an invasion of Taiwan. So in my view, what you have there is a good setup. You have a company that's been beaten up over macro concerns that might not pan out. Like, I don't think personally that China is going to invade Taiwan. I'm not too worried about that. I think if China did invade Taiwan, we'd be facing a world war. I'm pretty sure China knows that. And I think that that's not something that I'm going to lose a lot of sleep over. In my view, if China invades Taiwan, we have bigger problems anyway than what's going on with my stock portfolio. As far as a recession goes, yeah, I mean, the main argument I would have against a recession this year would be that everybody is convinced we're going to have one. So everybody that you talk to
is quite contrarian, yes.
Yeah. So my view is, whenever everybody is on one side of a macro view, that macro view usually doesn't materialize. So yeah, who knows? Maybe we'll have a recession this year. Maybe we won't. I'm willing to buy a stock that's beaten up over recession worries. And there's a possibility that recession might not even happen.
And TSM does pay a dividend of 2%. The only one of these does Google doesn't, do they?
Yeah, it's Taiwan Semiconductor is paying a dividend. Google does buy back stock. Facebook buys back stock. Taiwan Semiconductor does pay a dividend. Yeah.
Although obviously you're not investing for the income. You're more about the capital gains over the long term.
Yeah, I'm looking for a combination of all of the above. Like if I generally the way I look at it is I try to figure out what I'm going to earn through shareholder yield, and then try to figure out a reasonable growth rate for the business. And then if I'm buying them a little beaten up. So I'm hoping to also get some multiple appreciation as another source of gain.
Okay. And what are there any levels you'd be looking to add more of these?
Generally I'm in or I'm out. I put on a position and I give it some time to work out, and I'm not necessarily going to average into it. I've definitely had bad experiences in the past where I've averaged into a stock and haven't really been willing to admit that the thesis is broken. So
yes, I think we've all done that. The dreaded value trap there.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. You've talked about your portfolio. You call it the weird portfolio. How much of that is in individual stocks versus indexes, and how does that all play out?
Yeah, so I run two separate portfolios. So I have an account where basically I select stocks, and I'm trying to treat it as if I'm a business owner, buy them for a good margin of safety, hold them so I can actually get the results from the business. Then I run another portfolio, which is more of an asset allocation approach, where that's generally all through ETFs. So, and it's held through U.S. small cap value, international small, REITs, gold, and long-term treasuries, held in kind of a risk parity style asset allocation, where there's some defensive assets in there. There are some more aggressive, globally diversified assets in there with a tilt towards value. And the hope is, like, the idea behind that is I'm not trying to predict what's going to happen with markets. It's more of buy and hold permanent portfolio style allocation. Now, within my stock picking account, I use that as a proxy for cash. So instead of holding cash when I can't find businesses that are selling at attractive prices, I'll hold the asset allocation instead. So last year, I was able to pick up a lot of stocks that I thought were pretty attractive. I went into 2022 about 80% in that weird portfolio.
Right.
And then I reduced that to 20% as I was picking up businesses throughout the course of the year that I thought were pretty attractive.
And so that's where it is now. It's like 20% in individual value in the asset allocation portfolio and 80 in individuals.
That's right. That's right. And the goal is to hold about 15. When fully invested, I would hold about 15 stocks in an equally weighted portfolio.
How many do you hold now?
Right now I hold about 10. So the goal is to eventually, hopefully deploy that remaining 20%. But the markets don't seem to be cooperating. We're having a good year. So
surprisingly, right? Yeah, especially with tech.
Yeah. So as things get better, I haven't found as many opportunities, but I'm always looking. I'm always updating my watch list, and I'm always adding companies that I think are good for a long-term investor to my watch list.
How long is your watch list?
Right now it's up to about 100 separate names of
that's
companies.
Too much to get into here in a podcast. But can you give us some highlights of any that you're particularly looking at particularly closely right now?
Sure. So a company that I've recently looked at that I really like is NVR. So they're a home builder. They're focused more on the East Coast of the United States. They have a pretty nice business model where the company went bankrupt in the early 1990s. And out of that situation, they adopted a different kind of approach towards purchasing land. So what they do is, instead of what most home builders do, is they'll go out and they will buy land, build homes on it, and then sell the homes. So that makes you and NVR used to do the same thing, but that makes you very vulnerable if there's a big decline in the real estate market. You wind up holding the bag, you wind up holding onto all this property that you can't sell, and it's getting marked down. And NVR ultimately went bankrupt from that situation in the early 1990s recession. So from that, what they did was they started instead purchasing lot purchase agreements, which are basically options to buy land instead of actually buying all of their land outright. And then in addition to that, they pre-sell all of their homes. So basically they'll exercise the lot purchase agreement. They'll buy up like a piece of land that they want to develop. They'll have a model home on it. People tour the model home, and then they pre-buy the house, and they can often customize it with whatever features they want. So that business model makes them a lot more resilient whenever the real estate market declines. And that's allowed them to actually deliver really great returns for shareholders over a period of time. Since the mid 90s, it's returned basically a 20% CAGR over that period of time. So it's turned thousands into millions over that period of time.
That's wild.
And even if you bought it at the peak of the housing bubble back in like late 2005, and then held through 2015, you still earned a return that was comparable to the S&P 500, which you really wouldn't imagine if with buying a cyclical home builder and holding it through the global financial crisis. But that's the kind of company that NVR is. So I think it's a really attractive company to hold for the long term. With that said, right now, the real estate market is doing really well. I would prefer to buy it when things are a little bit beaten up in the real estate market, rather than buy it during a period of strength. So that's a huge one. I've added to my watch list, and whenever it gets a little beaten up, I'll probably buy some.
It is trading at right near an all-time high here. Interesting chart. If you look at it, they peaked in like late 2021 and then dropped precipitously until it looks like they had a bit of double bottom. Okay, I guess then maybe that was in line with the rest of it in October of last year. And since then, it's been on an upswing, recapturing its post-COVID high. So maybe that isn't that interesting of a chart, but yeah.
Well, I think last year you did have a situation where people were anticipating that the real estate market was going to decline, and that didn't happen. So, last year was probably a good time to buy it. Like I said, I would really like to buy it when real estate is weak, and then hold from there. But even if I think it's the kind of company where it does have some strong resiliency in the face of a recession. Like even in 2008, the company didn't lose money.
Wow.
Which is amazing for a home builder.
Yeah. It's weird. This is one of these kind of like Berkshire Hathaway in that they don't seem to have split the stock at any point. So it trades for almost $6,000 a share.
Yeah, they don't split the stock, and then in addition to that, they buy back massive quantities of stock.
Okay.
So they're constantly retiring shares and
Interesting.
aggressively buying back stock, and that combined with the growth in the business has really fueled great gains for shareholders.
Yeah, but not paying a yield, interestingly, which is the more tax efficient way of doing this anyway. Yeah.
Yeah, they focus almost solely on buybacks.
Interesting. Wow. Okay, that is a interesting one. NVR. Okay. Anything else that you're particularly closely watching?
Another company I've written up pretty recently is Deere. So those are John Deere tractors.
Yeah.
So that's another really great company. I think it's a little expensive at the moment, not terribly expensive. I'm hoping to pick that up at some point with a decent margin of safety. So Deere is obviously synonymous with tractors, but it's also well known for the quality of its products. So among people in the agricultural industry, they're known as the most reliable pieces of equipment that you can buy. So when someone buys one of their pieces of equipment, they know that that's going to last. And when you're talking about agricultural equipment, it's not something that you can really take a gamble with it. Like if it goes down for a day, you're going to lose significant amounts of money. So you need it to be very reliable. They're known for being reliable. You also need good service. So they're known for having a really high level of good customer service where they can go out and they can repair your equipment whenever that happens. They're also investing pretty extensively in technology. So they're developing autonomous tractors where they can go out and they can actually, drive themselves. And then that's all also synchronized with GPS. So they're investing extensively in technology, and they almost have the market cornered, where in the US agricultural market, John Deere is going to be the premier brand. I think it'll probably be the premier brand 20 years from now. So whenever Deere is available at a decent margin of safety, it's definitely something I want to pick up.
Interesting. This stock has kind of gone nowhere. It's down 13% year to date. Over the last year, it's basically flat, down 1%. And the forward PE is 12x. What do you at what level would you be buying here?
Yeah, I think at the moment that the low PE is a little bit deceptive because business has been so good over the last year.
I see.
So whenever I see something like that, when I see a company where it has a low PE, but it's on like incredible strength in the business, I usually assume that will mean revert a little bit.
Right.
So if you look at, for instance, trending in price to book or price to sales, right now it's above, 5x price to book.
Right.
If you're talking about a recession, it would probably get down to about 2 times price to book. Right. So I'd like to buy that on some weakness. I'd like to buy it when business isn't as good and anticipating that it will eventually mean revert, rather than buy it when business is hot and mean reversion hurts in the other direction. But again, it's kind of company for a long-term investor. It should do fine over a long period of time.
Yeah, the forward price of sales is 2x, and the forward price of book is 5x.
Yeah.
The forward price to cash flow isn't bad. That's 11x.
Yeah, exactly. And it is also a strong source of shareholder yield. So the total share count is down by about 30% in the last decade, and they are a dividend aristocrat. So they've been able to grow dividends at a pretty steady rate. So they've grown it from, like, if you were to adjust it for splits and everything else, it went from like below 50 cents to almost $4.50 over the last 20 years. So,
and they report earnings on Friday, if I'm not mistaken, this coming Friday, I believe. And this is interesting. Did you see Home Depot just reported earnings, and they said that consumers are scaling back big ticket purchases. And that stock's getting beaten up a little bit as a result. They lowered guidance. So any thoughts on that? Do you think that, this is an economic question, obviously. But if they're seeing it, then maybe somebody like Deere could too.
Yeah, it's possible. It's possible we could have the recession that everybody's worried about.
Yeah.
Like, I don't really know. I would just wait for one of these industries and one of these businesses to show some weakness, and then I'll buy it. So that's actually music to my ears that Home Depot is, it might be in a look, because that's another company I would love to own. So yeah, I'd love to see Home Depot get beaten up over a recession or recession worries, and then be able to buy it.
Interesting. Okay, well, that's all. What do you have a certain price that you're looking at for Deere where you would consider adding? It's now at 370 a share.
I'd like to own it around, I'd say 3 times price to book, at least somewhere in that ballpark. So that would probably be about, I don't know, 25-30% less than it is today.
Okay. So that's about, wow. So you're talking like sub 300 basically.
Yeah. And then I'd start to get interested in it. Like, I like to, basically my approach is to look for these compounders where even if you're a little bit wrong on the price, you should still do okay, unless you dramatically overpay. And then on top of that, try to buy them when they're in a substantial drawdown.
Okay. So yeah, they're probably not going to dump that much on earnings, even if it's a major miss.
Well, that's what I thought about Google and Facebook 2 years ago.
Okay. Yeah, true. But those are typically more volatile than companies.
Yeah.
Deere or Home Depot, who are so mature. Yeah. They haven't been at 300 levels since last summer, it looks like. Actually, last summer. Yeah. But doesn't mean you're right. And especially if there's concerns about consumers, you could see some stocks get beaten up unfairly.
Yeah, so, like I'm not sure if we're going to have a recession, but I would love to see one. I mean, that would be that would be a great time to buy some of these nice businesses.
No question.
Yeah, you'll have a lot of people sell for reasons other than the actual quality of the business. That's always a good story. And then on the top of that, people always extrapolate whatever's going on right now and assume it'll last forever.
Of course. Yes, on both upside and downside, they do that. Good times and bad. Very interesting. Value Stock Geek. You mentioned it. You have a Substack. How's that going for you? Because I've had a Substack going back about 2 or 3 years now, almost.
Pretty good. I've had a Substack since 2011.
Oh wow, they were around then.
Yeah, I'm not 2011. I'm sorry, 2021.
Okay, I was gonna say
I'm sorry. Yeah. 2021. I started it, and I started writing, and I basically started this project where I've been analyzing businesses and trying to find wonderful businesses to add to my watch list, with the idea that I want to capture these things when they're selling with a margin of safety. So basically building up a big watch list. Because what I found is whenever you have a good opportunity in the market, it kind of comes and goes. So I don't want to have to wait for a crash, run a screen, go dig through the screen during the crash. I want to own I want to know what I want to own prior to any crash or prior to any disruption in the markets, wait for it to happen. And then I already know, I have my shopping list and I know things I want to own and I know the prices I want to own them at. And that's the idea there behind the Substack is every week I'm evaluating a company. Generally what I'm concluding is, hey, this is a really good business, but it's not attractive at the moment. So I'm adding it to my watch list. Sometimes I'll evaluate businesses that I think are like superficially quality, and then I'll dig into them a little bit and I have some doubts about it and I won't add that to the list. And then occasionally I'll also go into businesses where, I'm not really sure about the quality, but it looks cheap. There's some quantitative metrics that look attractive, and then I'll dig into those as well. And then the goal is eventually to go through the whole S&P 500 and find and develop this watch list of, and potentially beyond that, I'd like to go into the mid cap space and places like that and try to find a list of really high quality businesses. And that's what I do on the Substack. Every week I publish a new write-up. On top of that, I'm also publishing updates on my watch list, and then I publish updates on my real-time personal portfolio where I'm actually going out and buying these stocks. Additionally, on the Substack, I also publish podcast episodes. So I'm interviewing a lot of pretty interesting investors. I'm also answering questions from the audience. And then usually what I do with that is I'll release podcast episodes first behind a paywall, and then I remove the paywall after a few weeks.
Oh, that's an interesting strategy. Yeah. And the podcast is available at securityanalysis.org.
Yeah, that's the website.
I'm just looking at it now. I notice here you have Clorox also on your watch list, it looks like.
Yeah, Clorox is an excellent company. That's a wonderful consumer staple. I think something like 90% of all homes have Clorox products. That went through a wild ride due to
Mm.
COVID. So
Yeah.
obviously they had business. COVID was great for their business, and then they've had a little deterioration in that.
Mm.
I guess because everybody's houses are fully stocked with cleaning products at the moment.
Right.
But yeah, it's pretty expensive at the moment. But at
Mhm.
some point, I'd like to own that. It's
Yeah,
probably the kind of thing I could pick up in a recession.
for sure. Yeah, it got somewhat a little cheaper again towards the end of last year. And since then it's been on a bit of a rally. I watched them pretty closely as well. Okay, cool. That's real. Wow, that's really interesting. And then of course on Twitter, Value Stock Geek is that your handle there. You have a lot of followers, a lot more than me. Have you used the Substack notes yet? And
I
are you
have.
seeing that? And what are your thoughts on that versus Twitter post Elon?
Well, it was pretty disappointing when Elon banned the links to
Yeah.
Substack. That happened briefly, so that was kind of annoying, and it made me question. I actually did go out and buy the blue check specifically to promote my Substack. That was the whole point of it.
Yeah.
And then when they tried to ban Substack, that was pretty irritating. And then they also that ban has been lifted, but they've also it seems like they are still suppressing Substack links a little bit.
Throttling it, yeah.
So I'll definitely get more engagement when I don't post a Substack link.
Yeah.
So that's a little irritating. So anyway, I've tried Notes as an alternative to it. Unfortunately, there aren't as many people on there, so it's not as great a platform to promote a Substack. And they definitely need to get more of an audience on there. And Twitter still kind of has the game cornered with social media. So. But Substack Notes is nice. I like what they're doing. I like the effort that they're making, and hopefully it gets bigger in the future. I'm definitely posting on there, and I would encourage anyone listening to join it and try it out.
Yeah, same. And I've had a good dialogue with Linda over there at who does the financial piece at Substack. And
she's awesome.
She's really cool, and they seem to be doing a lot. And they take a lot of suggestions. Although one that I've given her a couple of times that she hasn't followed up on yet, I'm assuming there's a reason for this, is that you know how they have the stock tickers get linked if you write it in an article, but if you do it like Twitter, like you put a $sign in front of the ticker, but not on the notes. So which is unfortunate that you can't do that on notes. Yeah.
But at least, like you said, they're open to suggestions, so I'm sure they'll probably add that, I would imagine, hopefully, in the future.
Yeah, you would think. Yeah.
And they definitely seem a lot less crazy and volatile than Elon. So, it's like, what the hell is he going to do today? You never know.
Yeah, it's just ridiculous. I know. And throttling Substack, this just hurts him, you would think, right? I mean, yeah, it's just petty and whatever.
Short term, it makes sense. I mean, keep people engaged on Twitter, but then if you take that too far, eventually, I would imagine people would migrate away from Twitter as the premier social media platform.
Except there aren't really any alternatives. I mean, people have talked about this blue sky thing, which I've been trying to get an invite for forever.
Me too.
And haven't been successful. But the other one that was awful. I forget what it's called now. It was right when Elon took over. People were screaming about it, and it just didn't work. So there's the reason that nobody's displaced Twitter yet. And, maybe the barrier to entry is a little higher than we think.
Yeah, it could be. And then I imagine in the future, we won't be dealing with Elon at some point.
At some point. Yeah, you figure. Already now he's stepping back and having this woman take over as CEO.
But yeah, I don't know if the debt load that they took on is sustainable. So,
well,
I imagine it'll probably at some point get owned by the banks, and then they'll sell it to someone. So
yikes! Yeah,
we'll see.
That was a great arbitrage opportunity, by the way, when he bought them.
Yeah,
I don't know if you probably don't do any risk arb, but that was like a rare instance of basically a layup, because there was no way he was getting. People who looked at the agreement, they were like, "There's no way he's getting out of this." And there were times when it sold off well below the takeout price, and could have locked in some nice gains there.
Yeah, those who did that, it worked out pretty well for them.
But I didn't buy enough but anyway, and that was just more luck. But anyway, yeah.
But there was some uncertainty. Like he could have, I don't know. I've seen him do all kinds of crazy things before where he's been able to weasel out of things. And
yeah,
I don't know.
That was the concern. Yeah, that was the concern, that he was going to somehow find a way to weasel out of it. But if you looked at ARBs, like if you look at like the legal precedents, like basically for him to do that it would have been like a legal, like a mess. And created a new precedent that like nobody would have wanted to deal with. And so from that perspective, it was a layoff. But anyway, so much for that. All right, cool. So so check out Value Stock Geek on Substack, the website securityanalysis.org. And of course, Value Stock Geek, the Twitter account. Anywhere else on social media or anywhere else? I imagine you don't have a YouTube.
Yeah, that's it. Securityanalysis.org, and then my Twitter, where my handle's at Value Stock Geek.
Cool. Very nice. Awesome. Value Stock Geek, thank you so much for coming back on the podcast again. Look forward to having you on at a future point, maybe in a year or so. Maybe we'll have a completely different economy then. Maybe it will be shopping season for you. But for now, this is what we got. And with that, we thank you all for listening. Thank you, Value Stock Geek, for coming on. And with that, look forward to seeing you all again here next week. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.